We've got a special guest joining in today on the show as well, Jerram, Chief Economist, Bank of Singapore, joins in to analyse the macros that we are working with right now. Richard, thanks for joining in from Singapore. As far as India's August IIP is concerned, do you see the tide turning for capital goods, and how do you see consumption output for September?
Yeah, I think it's going to be another quite poor month for industrial production, probably around a 2% year-on-year growth number. And we've seen in the last couple of months the PMIs, the manufacturing PMIs, have fallen back below 50, which is really quite unusual for India. And I think that does suggest that the industrial production is going to keep struggling, probably right across the board. I mean, consumption has been particularly weak lately, but it's hard to see much prospect of capital goods showing much dynamism.
So do you think that industrial activity has now bottomed out, and do you see a pickup to the project clearance by CCI and government expenditure in the second half?
I don't think it's realistic to expect much of a pickup. I mean, I think the currency weakness will help to some degree. It'll boost exports, but you've got to also think higher interest liquidity, that's going to be a squeeze on production. So I wouldn't be looking for acceleration to come as a result of any of the government.
Richard, how do you expect the central bank now to react to all this data that's coming through? Do you expect a 0.25% repo rate hike like much of the market is, or could it be even 0.5% through the course of this financial year? Or do you think there's a case for a hike by the RBI in its data this month?
I think it's most likely that RBI stays on hold unless you get a real negative surprise in the inflation numbers. I mean, it's fairly clear that high interest rates are going to be hurting growth, so they're going to be push rates up unless they have to. And I think the fact that the currency has recovered somewhat over the past month suggests they really probably don't have to push rates up anymore at the moment.
Richard, trade deficit for the month of September has narrowed to now 2.5-year low. Is the low trade deficit sustainable, and do you see the current account deficit to surprise much below the $70 billion mark for FY14?
Yeah, I think the trade deficit improvement probably is sustainable. I mean, clearly the weaker currency is going to help exports. That seems to be coming through already, and stifle imports as well. There's a few questions about whether the squeeze on gold imports can be sustained or not. But I think it's fairly clear that the trade deficit is going to be narrowing. And, of course, that feeds directly into the current account numbers. I think for the coming 12 months, deficit of 60, 70 billion maybe for the current account looks reasonable. Now, of course, that's an improvement, but it's still a very big number, and it does still mean you need to attract a lot of capital inflows into the country. And, of course, that's going to be a constraint on the RBI in terms of how aggressively it's going to be able to ease policy once it decides that inflation is under control.
But Richard, before we wrap it up, your call on the currency, do you think the rupee is now stabilized in the current range that we're seeing, about 61 to 63 odd to the dollar? How do you see rupee behave over the next 3 to 6 months?
I think it's too early to be confident that it's stabilized. Of course, we're going to be looking again maybe in 2 or 3 months at the prospects of Fed tapering. India still has a large current account deficit. It is coming down a bit, but it's still very large. And as a result, India will be singled out by the markets as a country which needs foreign capital, and capital is going to become more scarce once the Fed starts to taper. So I think it's too early to be comfortable that the rupee is going to be settling into a 61, 64 range. Of course, you've also got to think at some point in the next 6 months, I think 1 or 2 of the rating agencies are probably going to downgrade Indian debt to below investment grade, to junk grade, and that could also put some more pressure on the exchange rate.